Well, welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is December 15th of 2021. There's a lot in the news, and I thank you for taking your time. I know it's a very busy time of year, holiday shopping and getting ready for loved ones, and then also getting ready for year end. And in fact, that's why we're here. We're going to prepare you not only for year end, some sort of tips and strategies and thoughts to think about as it relates to wealth planning. And we'll get to that in just a second, as well as prepare you for what we believe is going to be a very big planning year in 2022. All things focused on Washington right now. And for that, to discuss that, we have Bobby Linskey. He is a senior planning wealth strategist with Putnam, and he is very well connected, as well as Putnam, with regards to Washington and Capitol Hill. So we're going to go through a lot of Q&A, a little fireside chat today. I know it's 40 degrees where you are in Boston. Is that what you said? It's a Chamber of Commerce day here. We just had a weather storm yesterday, but we got snow-capped mountains in Palm Desert, California. And so I'm not trying to rub it in, Bobby, but what I'm saying is next time we'll do this in person, and we'll have you come out maybe in January at some point in time when it's better weather out here, and we'll come out. But Bobby, thank you for coming, and thank you for joining us on this Zoom call today.
My pleasure. Thanks for having me. And I certainly look forward to doing the next one in person. I have no qualms at all about traveling to Palm Desert in January.
That seems to be a recurring theme, right? We're getting in season, as we call it, just after January through April or May, and we'll set something up in the new year for sure, because I think we're going to have more than just this discussion today as it relates to what's happening in Capitol Hill. Why don't we start there, because there's a lot of news related to that. In fact, you and I, before I went live just now, you were giving me an update as to one of your sources. So why don't we just start with that? Because we're going to discuss today the Build Back Better, the $1.7 trillion bill that's been passed by the House. We're waiting on the Senate. And we've been waiting quite some time, since November. Usually it goes, within a week, 2 weeks, maybe 3 weeks. But I think the longer this lingers, the more sort of in peril this becomes. And it becomes sort of a political issue, as it has been all year. But this is, will the bill get done? We're going to ask that question too. But what's the latest update right now as it relates to Washington?
Rob, you just laid it out really well. This has been something that's been going on for an incredibly long time. And frankly, the longer that it goes on, it seems a little bit less and less likely that it may happen. But certainly over the last few months, we've seen it being pared down significantly. As you mentioned, I was just on the phone as part of a member of Boston Asset Management Association, and we get the privilege to speak to various political figures in Washington. And we were on the phone with one of the congressmen in the House. And what he was talking about is, don't forget that this Build Back Better plan, it actually started out as one comprised piece of legislation along with the infrastructure package that we already passed a couple of months ago. And their thoughts were, all right, we're going to have the vote in June. It's going to get through the Senate in July, and it's going to be passed by the end of July. Here we are, December 15th. And not only did we see it split into two bills, but only one of them has been passed. And, you mentioned the price tag of $1.7 trillion. When this started, and we saw the House Ways and Means Committee come out on September 13th with their proposal, it was $3.5 trillion. It's been scaled down nearly 50%. Now, the good news with that is that it was $3.5 trillion. Now it's about 1.7, as you mentioned. But that also means that a lot of the tax increases have also been taken out of the bill. That certainly would have impacted all of us as well as our clients. Now, the reason that a lot of those tax increases got taken out is because, we no longer need to raise taxes to support a spending package of $3.5 trillion. It's 1.7, as you mentioned. So where do we kind of stand as far as what's in and what's out? Well, first and foremost, we thought we were going to see an increase in the corporate tax rate from about 21% to 26, 27. That did not stay in the current reconciliation bill framework, which is kind of what we are staring at right now. There were some other nuances for corporations, such as a global minimum tax and excise tax on stock buybacks. So that was, for the most part, taken out. But in addition, we didn't see an increase in capital gains taxes as of right now in the proposal. We didn't see an increase in the ordinary income rate, which was going to go from 37 to 39.6. We didn't see the estate tax exemption, which is $11.7 million in 2021. it's going to be a little bit north of 12 million next year in 2022. We thought we were going to see an acceleration of that sunset to about $6 million. That also has been taken out of the proposal. And then there were certainly some other things around required distributions for large IRA balances, and well as some changes to small business owners and the deductions that they have. So, if you're looking at it from a tax standpoint, I guess the good news is that, a lot of those increases, especially for middle and high income households, those were taken out. But it certainly is still right now at a bit of a standstill because the progressive Democrats and the more moderate Democrats can't seem to come to an agreement around a couple of the spending aspects of it, as well as some of the tax increases that are going to pay for those spending items.
Isn't that incredible, Bobby? So we started the calendar year of 2021 almost like, if you were to look at betting odds and even go back to our research of what Wall Street and all the economists and all the experts from Washington were basically seeing the setup for the 2021 year, higher corporate tax rates, higher personal tax rates. We were engaged with all of our clients' estate planning teams because the estate planning law, as you just mentioned, is going to be impacted negatively. So taxes are going up everywhere. In fact, the fact that we're closing year end with positive markets is one of those reasons. As we do our client year end reviews, again, another great year, very good year for our clients, and clients are very surprised as it relates to sort of the returns that we've seen in the equity markets. And that's all because of, at the beginning of the year, the expectation was, right, sort of the factor and the level set of higher taxes, personal, corporate, and everything. And then we get, through the summer, and you get Senator Manchin and Sinema, and a razor thin margin in the Senate. And then now you have it kicked back to the Democrats within the Senate now having to literally horse trade amongst themselves. So where we started to where we're finishing is sort of the relief that we're getting here at year end, and the markets are as a result of that. And so what we see for 2022, as I'm talking to our clients and we're setting up portfolios, rebalancing, so on and so forth, we have to then keep in mind, again, we're not out of this yet. We're not out of the woods. And again, I think the betting odds right now are still, we're going to see something, because that's, 2022 is a midterm, right? So it could be political suicide in many ways for, those that are running, depending upon, whether it's red or blue. This is the hottest political button. So the question right now, Bobby, is does something get done between now and year end because of the midterms are right around the corner?
Yeah, it's, Rob, when you reviewed some of those, things that we thought we were going to see, increases in corporations, the top marginal tax bracket restored to 39.6. I remember doing presentations this summer and into the fall, and I'm saying, listen, the low-hanging fruit is increasing taxes on corporations, restoring the top marginal tax bracket of 39.6. Those are no-brainers. Those are easy things to get done. When we saw the proposal come on September 13th, I believe I saw betting odds of there was a 62% chance it was passed by October 31st.
Hey.
And, here we are, December 15th, and it's really stalling. And to your point, it's not the Republicans versus the Democrats. It's actually the turmoil within the Democratic Party. And you have the more progressives, such as Bernie Sanders, and then you have the more moderates, such as Joe Manchin in West Virginia, and they really can't come to an agreement. And as it stands right now, they seem to be very far apart. As I mentioned, I was just on a call with a member of Congress, and he was saying, to Congressman Bernie Sanders, he's actually been fairly willing to compromise in comparison to what he had, done in past years and, his track record. However, there's definitely a standpass. Senator Manchin, West Virginia, he wants the child tax credit removed from the Build Back Better Act. Whereas, Bernie Sanders, he wants that to remain. And, as far as dates that we're looking at, you think about it, January 15th is going to be the last date in which the recipients of that child tax credit are going to receive that check in the mail. So is that pending, end of January 15th going to push them to get it done? Because when you look at other things on their schedule next year, January 15th and December 31st are really the final two dates they have that we're really going to say, hey, if we're going to get this done, it needs to be done by either December 31st so that we can say we got it done in 2021, or is it January 15th because we need to make sure we get it done prior to the child tax credit expiring. Now, you mentioned midterms coming up next year. And I have heard from, through the grapevines that, the other thing that's really important to those, creating legislation in Washington is the concern of voting rights. And, there's talk about, how can we get voting rights, for basically everybody? And can we get some type of carve out, one-time carve out to avoid the filibuster so we can get this voting rights legislation passed prior to 2022 midterms taking place? So they may say, the Democrats may decide that, hey, we are going to get more political leverage out of getting this voting rights legislation passed, which essentially would allow more people to vote than we would getting political power by having the Build Back Better passed. So does it get passed? Frankly, as each day goes on, it seems less and less likely. We do have until the 31st, but I think it's going to be pretty hard pressed to get, members of the Senate and the House to stick around DC from, call it, December 23rd to December 31st. So certainly if this does linger into 2022, you may see the Build Back Better Act kind of just fall apart. From there, maybe they pick out a couple of articles or a couple of aspects of it that they think are really positive. Is that immigration? Is it the child tax credit? Or is it some of these tax increases? Is it the SALT deduction? That's certainly something that is, near and dear to your heart being in California, near and dear to my heart being in Massachusetts, and certainly very important to a lot of blue states, especially up here in the Northeast. I think New York, New Jersey, parts of Pennsylvania, Massachusetts, Connecticut. So there's definitely a lot of aspects of this piece of legislation that are really important and viable. It's just a matter of, can they come together? And, you mentioned the 50-50 Senate. President Biden put it this way. He said, when a 50-50 Senate, every single person thinks they are a president and can act that way. And that's what we're seeing with Bernie Sanders. That's what we're seeing with Joe Manchin, as well as Kristen Sinema, who have really, put their foot down, drawn a line in the sand saying, we are not going to budge unless X, Y, and Z is included or taken out of the legislation.
Well, I think what we can really see on a go-forward basis is the skinny down version, right? I mean, literally you ask, it's just part of the negotiating 101. You ask for, everyone gets a voice, right? Everyone gets what their wish list is. And then you get down to reality. I just can't help but think that next year, 2022, there's so much on the line. It's going to be, each one of them are going to have to think real long and hard as to what's really important to their constituents, what's really important to their political life. And then I think that's when we're going to see something or not happen. I think something will get done. We could see in two different bills, if you will. But I still think why we spend so much time, especially with our partners here at Putnam, on daily research from Washington and Capitol Hill, Blanke, Schein Wealth Management, is that's how we, number one, think about how we position portfolios accordingly. The asset allocation, the opportunities that are out there. Again, whether you're blue or you're red, our clients care about green at the end of the day. And that's what we solely keep our eyes on. And even though you can get really political and so polarized in every one of the issues we talked about, and the deeper you go down that, the more everyone starts digging in. And that's why Congress is having a difficult time in Washington right now. We can completely understand that. But again, we have to then say, listen, emotions and personal feelings and beliefs out of this, and let's how we position. We did this for many decades here at Blanke, Schein Wealth Management. Most recently, when we had President Trump, but it was the runoff or the elections with candidate Clinton and candidate Trump. During that, there was a lot of buzz around cybersecurity. And we made a position strategically for our clients in terms of cybersecurity. And that has paid off. Going back before that was, with under Obama terms 1 and 2, it was healthcare, and we just strategically over allocated healthcare. And again, that works out. So why we spend so much time and attention is because, well, quite frankly, let's be honest, Bobby, it's yours and mine's and everyone's tax dollars going to Washington. And now you want to see the allocation, right? You want to see where those tax dollars will be spent. And then you want to line yourself up with those companies down the road that will benefit as a result, whether it be infrastructure, whether it be healthcare. So there's going to be a lot of opportunities, and that could go whether we have a recession or not, because we're talking about billions and trillions of dollars. And I don't think many people especially understand what $1 trillion actually is. So that's a lot of money. You could be in the middle of an economic hurricane right now in terms of the way the economy is, but you can have that one contractor or that one company that has a government contract for billions of dollars, and their earnings are going to just, it's like they're on an island and they're going to continue to execute and do very well in the middle of, let's say, an economic pullback for the economy. And so that's why we spend so much time. We do the research, due diligence, and then we work that information back into it. So now let's get into, you mentioned the SALT deduction. Take 2 seconds, talk about that, what that is. Politically, we was in there because 2017, when Trump was in office, it was kind of like a, let's call it what it is. He basically was no favor to the Democrats, and those are the blue states, call it New York and California and where you are, simply because he brought the state and local deduction down for, if you have a real estate, you can only deduct up to $10,000. And that was a cap, the $10,000. Previous to that, it was unlimited. The bill is going to talk about up to 80,000, depending upon, or 40,000 for trust. But talk about the importance of this.
Yeah, absolutely. I mean, certainly near and dear to my heart. I remember in early 2018 doing a lot of business trips to New York and doing presentations. And you would have thought that I was the individual that cut the SALT cap or SALT deduction down to $10,000 by some of the comments that were made. And I certainly was saying, hey, I'm on your side. I live in Boston. I could certainly use that deduction as well. But to your point, since 2017, our state and local taxes, property taxes that we can itemize on our tax returns, it has been decreased or capped at just $10,000. And certainly for many of us, our property taxes, real estate taxes, state and local taxes, far exceeds $10,000.
Well, just an example, California and what we've seen with property values in the last 24 months, have just unbelievably skyrocketed. So call it $1 million house, right? With a 1.25 tax, 1.25% tax, you're 12,500 just on the tax, right? So, but it's capped at 10,000. So they knew what they were doing when they did it, especially in the high rent districts, if you will, high states that have appreciated in high real estate.
And you just mentioned the appreciation too. The other thing to think about is, we've seen housing prices go up significantly.
Yeah.
The SALT deduction isn't, adjusted for inflation. It's been at $10,000 since the very beginning of 2018, when we've certainly seen an immense appreciation in real estate, and it hasn't kept up with it. So, that kind of just goes to show you that it didn't make a lot of sense to begin with. Now, having said that, you talked, it's $10,000. It's really interesting. This is something when we were looking at what may be included in here and what may come out, my team and I, we pay a lot of attention to what's going on. We listen to folks in Washington. We have the lobbyist firms that we work with. And everyone kind of said, hey, I don't think SALT's going to find its way into any of this legislation. The reason being is, why spend any amount of political capital trying to bring this deduction back in when at the end of the day, the Tax Cuts and Jobs Act does sunset at the end of 2025. So we were going to wake up January 1st, 2026, revert back to our old tax system, and at that point have our full SALT deduction back. However, we mentioned midterm elections coming up next year. I truly think, those in Mass, New York, New Jersey, California, they said, hey, midterm elections are next year. I need to do something for my constituents back home. I need to show them that I am working for them. And, those hard-earned tax dollars, I'm trying to reward them and basically bring back this deduction. So currently at 10,000, we've heard numbers of around, 72 is something you saw at one point. Most recently, it's been an $80,000 deduction, or the max deduction you'd be allowed to receive is $80,000. From there, we saw Bernie Sanders also say, well, hey, the research shows that this deduction favors, mostly high income households. You could say some middle income households, depending on, the zip code. But, this Build Back Better Act, it's really meant to help low income households. Yet this deduction favors high income households. And at that point, he wanted to put some type of income cap on it. We saw numbers of $400,000, $550,000. I believe the senator in Colorado, he had a proposal of $1 million, meaning that if your income was above whichever threshold they ended on, so let's say it's $550,000, if your income is above $550,000, you would still be stuck at that $10,000 cap. You wouldn't get this extra relief of $80,000. Now, there's a ton of political back and forth. We really haven't seen much. An interesting thought I heard recently from one of the lobbyist firms I talked to is they're agreeing that, listen, 10,000 is way too low, especially as we've seen an increase in home prices, but maybe 80,000 is too high. Maybe it settles somewhere in the $30,000 to $50,000 range. And if it does settle in that $30,000 to $50,000 range, the income threshold comes out completely. So there are no more income parameters tied to that. That's certainly a big sticking point, I think, because as I said, the progressives don't want to see this tax break go to the wealthy, yet the Democrats that represent those constituents back home, they know they need to do something to help out them, especially with midterms coming up next year. So that's certainly something that's getting a lot of political attention. And I think it's very polarizing because of the points you made. It was obviously done so by President Trump during his presidency, and it negatively impacted primarily blue states. So we will certainly see what happens.
I think right now with the SALT, because it wasn't in and now it's in, and now they're sort of flushing out the details where they land. I think it's safe to say we're going to see something. I think it just remains to be seen. So that could be, better than 10,000. Let's hope and wait and see. And the word was, if it is passed between now and year end, 2021 would be included. Not too much legislation is retroactive. This is one of those that I thought was interesting. So yeah, if we want to see a midnight Congress gets together, like you said, and the Senate makes something happen, that could be a net benefit to everyone. I think most of all of our clients. So that's something. Let's go to strategies for clients to consider prior to year end. In addition, most of the stuff in terms of when we get sort of the fourth quarter congressional legislation, when it's passed, very few, especially if it's a tax law change, it's very, very, very rarely retroactive, right? Because it's so hard to. But what are some strategies that we could think about between now and year end?
Yeah, so as we mentioned, most of the tax increases are going to be coming out of this bill as it looks right now. The proposal, I keep saying it's a proposal. Nothing is solidified.
Let me stop you right there, because devil's in the details, right? So the way they're actually setting this up, and the way, it's not like the progressives or the Democrats or even Republicans say, oh, wait, we're going to table this because we can't get the bill out. The way the Trump legislation, right, the tax law change in 2017 under President Trump back then was passed, a lot of this in like 2025, 2026 expires. So the estate tax, right, we're still going to have to sit with our clients next year and think about, one, asset valuations have gone through the roof, right? Our real estate, our equity portfolios, our art, a lot of things have almost doubled in the last 24 months. And I have more of my clients saying, Rob, thank you to you guys at Blanke, Schein Wealth Management and your team and everything that you do. We have never felt so like financially safe and secure, but been so insecure about the world that we're living in now, whether it relates to estate planning. And estate planning now, on a go-forward basis, that comes out of the bill. So they're sort of factoring in, because it just sunsets. So estate taxes go up in, you blink an eye and it's 5 years. Or 4.5 years. So we're almost there. So be careful when we say, not you, but anyone in the planning world, to say we're safe, because we're not. In fact, it takes 2.5, 3 years to vet some strategies that might be right for you and your family with your team, your CPA, your estate planning attorney, and us as your financial advisory team, to have several meetings to basically, what we like to say is, you measure twice and you cut once, right? Especially on the revocable, irrevocable side. But that's what we're spending a lot of time on. We will be for our clients in 2022 as well with their team, because there are some sunsetting factors that are happening. But again, between now and year end, what are we thinking about?
Yeah, so one of the aspects that's still in the bill, for example, is the backdoor Roth IRA strategy. That is going to be repealed at the end of this calendar year. So, if you have income that's too high to contribute into a Roth IRA, a strategy that many may use is they may call it $6,000 of after-tax money and put that into a non-deductible IRA and then convert it to a Roth. That strategy is going to be repealed because you will no longer be able to make Roth conversions using after-tax money. So any money that's also held within an employer plan that may be after-tax contributions. Those are conversations that need to be had with your financial advisor if that strategy makes sense to do one last time before year end. But the other thing to think about is we've been talking a lot about SALT recently, right? Well, it sounds like if we get some relief next year, our itemized deductions are going to go up significantly. So if I'm somebody that's charitably inclined, I may think about making a large charitable contribution next year. The reason being is because I can combine that with my SALT deduction, and therefore I'm going to have significantly more in itemized deduction. So if I'm somebody that was thinking of funding something like a donor advised fund or some type of charitable trust, next year may be the best year to do so, because I can combine that very large charitable contribution deduction with a potentially higher SALT deduction. And now all of a sudden, if I have a large amount of itemized deductions in 2022, you mentioned taxes going back up come 2026. Maybe that's an opportune time for me to do something like a Roth IRA conversion to create that tax-free account, because I think one thing we can all agree on is that our fiscal deficit continues to grow and taxes eventually are going to be going up in the future, whether it's done through the Build Back Better Act or another piece of legislation down the road. So I certainly think about backdoor Roth IRAs before year end. And the other thing I'd look at, Rob, is when I look at the House proposal that came out on September 13th, I essentially said, this is a hit list of what policymakers want to curtail for high net worth clients. They want to try to curtail a lot of these advanced wealth transfer strategies that you utilize with your clients, especially in conjunction with your estate planning attorney and your CPA. And to your point, it doesn't just take, a day or two or a couple of weeks to put some of these, plans into action. It takes a long time to ensure that this is the best thing for you and your family, and for your children.
So Bobby, why don't we do this? Why don't we talk about one of the things here, what you said, and in fact, that is the conventional thinking now. Somebody said that, you just said it, is this right now is what is being referred to as a high net worth hit list that was passed in the September bill by the House. And so we know what their wants and sort of targets are. And one of those is like a Grantor Trust, estate planning world. Yeah. Can you walk us through that and go through sort of things to think about, what it is and consider, and how it's being sort of thought about in Washington?
Yeah, so certainly when I saw that they were going to change the rules around Grantor Trusts, I got a funny story I'll get to in a second, but just to kind of establish what a grantor trust is, it's designed to allow the grantor, or the person that's transferring the property to the trust, to retain certain powers over that trust property. And while a grantor trust is not considered a separate entity for income tax purposes, meaning that I still pay the taxes on that trust, it is considered a separate entity for estate tax purposes. So therefore transferring property to a grantor trust removes those assets from the grantor's estate. And what the rule change was going to be is that essentially the grantor was going to be considered the owner of that grantor trust for both income as well as estate taxes. Now, the good news that they provided us, is that any grantor trust established prior to date of enactment. Now, date of enactment would be whenever this legislation passes, we're going to be grandfathered in. So one of my golf buddies, after, a week or so after this passed, he's an estate planning attorney. We were joking around on a Saturday morning about it. And obviously you can imagine our playing partners were just enthralled with our conversation around Washington updates and
you guys are
Grantor
geeking
Trusts.
out over estate planning 101.
Yeah, people are like, are you guys done yet?
Yeah.
But anyways, his comment was that every CPA financial advisor that I've given my business card to in the last 5 years has probably called me in the last week asking to set up trust for their clients, prior to this rule change. Well, as you know, it takes a lot of time in consideration with the family members to determine what is the right decision, what's the right structure, what's the right thing to fund the Grantor Trust with. So that was going to be, very impactful, because think about what a Grantor Trust includes. That's GRAT, so Grantor Retained Annuity Trust. It is qualified personal residence trust. It is ILIT, so irrevocable life insurance trust. These were all going to be impacted by this change. So as you mentioned, I look at that one pager that you were just holding up as a hit list. Yeah. If what I say is, when I'm talking to clients and financial advisors alike, and I'm sure this is exactly what you're doing with your clients, Rob, is that I look at this hit list and I say, all right, if any of these things happen, if X, Y, and Z does pass, how does it impact our financial and our estate plan? And if so, what is our course of action? What do we need to do prior to this or after this in order to make sure that it doesn't negatively impact you to the fullest extent? And I start having these conversations now because, as you mentioned, it takes time. It takes years to get some of these things set up and funded and really, made sure.
It's all about the education. And that's what we provide here at Blanke Schein Wealth Management, is the ability to connect with you, to listen about your personal situation in life, your goals and your feelings, and then also bring in sort of the subject matter experts to educate the good, the bad, the nuances. What am I seeing? What am I not seeing? And then it's for you and your family to decide, go home, sleep on it for a week, a month, half a year. But you want to do it sooner than later, because I guess the good news is that the cheat code is here, right? So exactly. At some point in time, one of the things that I've done personally, it's been a very successful tool for my family planning and tax strategy, is a donor advised fund. And a donor advised fund can be set up as little as $5,000, and it's a separate account. We can set it up for you here at Blanke Schein Wealth Management. We can manage it for you even as well. But what's great about it is once you set it up, it's a separate account. You can fund it with just about anything. Highly appreciated assets is the best way to go. And you could think about it. You can do planes, trains, automobiles. You could also do anything from real estate you can't sell, like land. Fidelity will help us with that as well, to highly appreciated assets, like I said before. That's what I did with mine. I had I've been with Morgan Stanley for many years, and I had some legacy shares of Morgan Stanley that we got when I first started many moons ago. But instead of selling them, I just put them in I basically took the shares that I want to donate, open up a donor advised fund, place the highly appreciated shares of stock inside that donor advised fund, which I still am in control of. And then once those shares went in, we liquidated them. There was no cap gains because of the sale, because it was in a separate, basically it's outside your estate and it's outside, you've actually given away. I can never get that money back because it's in a nonprofit, if you will, from the 501c3. This one's run by Fidelity, the one I use. But I get in the calendar year that I do it, I get the deduction of the dollar amount on the day of what the asset valuation was made. But then I have 5 years to distribute those funds, where I can actually distribute them every single year. Well, we love it, and why we set it up this way is because it's an easy and efficient way for me, let's say in the community, it's a one stop for everything. So if I get a $50, from, let's call it my kid's school request, I can go in there on my phone in an app, and I can send it out from my Fidelity right to the kid's school, saying Jack Schein for the bake sale or whatever. Therefore, I get the date time receipt, I get the credit, or the child gets the credit at school. I know it's already, taken care of from a tax standpoint because I did it throughout the calendar year. And I can just refill the bucket if I need to any point in time. And the best part is that this thing has grown, right? It's appreciated once it's outside my estate. And it's been a wonderful gifting tool, strategy, easy, efficient, and it just keeps everything sort of nice and tidy on our side. So if you want more information on what that's called, a donor advised fund, we've done that for many of our clients. And again, as little as $5,000, we just set it up. But again, going forward, we're going to be doing a lot of that, those little strategies from time to time. When you give to charities, this is the year end, right? Year end, we're thinking about those, not only our loved ones, but also those in the community, and those in nonprofit world, but also let's call it the Red Cross, that are helping those in Kentucky most recently from the unfortunate tragedies of the tornadoes that we just saw. So when you donate, we advise our clients the highest and best use is we can always donate stock, right? There's a local church here that we're involved in. There's a local charity that we're involved in, especially here in Palm Desert, California. We have 110 golf courses. So I don't know, Bobby, if you're a golfer, come on out and golf. And I make that reference because we have over 1,100 charities. Like, we're charity mecca. So every charity, just about, whether it's the local Eisenhower Medical Center, or they have a brokerage account set up, and that's designed solely, specifically to take in stock. And our team here knows how to do that. We will sit down with you. We'll identify the highly appreciated asset, and then we will then transfer from your Fidelity account or Schwab account directly to that entity of choice, that nonprofit, between now and year end. The process is simple on our side. We make certain that we connect with the office on the other side, and then they'll send you a thank you letter for donation purposes for your taxes in any calendar year that you make that donation. But I will tell you, every nonprofit, every church or local thing that you're passionate about, if you want to make the maximum impact, we don't want to see you write the check. The checks are easy. Cash is easy. You need to donate the stock or donate a highly appreciated asset. I mean, gosh, if we bought, Apple for many, many moons ago, like we did for many, many clients, our Apple cost basis is very, 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 very little, right? I could go down the list on all the equities, but that's a perfect case in point. So we'll just send them shares of Apple, and it's a win-win on the other side. They're not going to keep it. They're not going to invest in Apple. They're going to sell it on that side because they have their own investment policy. But it's just a great time to think about giving, but giving smartly.
Yeah, I love donor advised funds. I talk to them about them all the time, Rob. It's fantastic to hear that, you use it personally, your clients do, because, to your point, it's one of the most efficient ways to give. Put that appreciated securities in there. The reason you don't want to sell the security is because of the capital gains tax you're going to pay. Well, not only can you instead get that large deduction, the money doesn't go to Uncle Sam quite as much. And the other reason I think we've seen a huge pickup in donor advised funds too is, the talk we had earlier about the SALT deduction. If we only have 10,000 for our SALT, the other deductions, your mortgage interest deduction. And other than that, really the only other itemized deduction for most is charitable contributions. And with the standard deduction being so high, for many, they barely see the tax benefit on their charitable contributions. So what many decide to do is say, hey, if I usually give, call it $10,000 a year to my favorite charities, well, if I do $10,000 SALT, $10,000 to charity, let's say my mortgage interest deductions, 6 or 7, I'm barely getting over the standard deduction. Maybe instead I want to fund a donor advised fund with, call it 3 years worth of charitable contributions, and have really large itemized deductions in that first year. And then I can make my distributions to my favorite charities on an ongoing basis. So I think they're a fantastic tool. The other reason I love them too is I worked with this client down in New Jersey a number of years ago, and he was extremely philanthropic, and he really wanted his children and grandchildren to follow in his footsteps, as he was really involved with a number of passionate charities of his, but they just didn't necessarily have the financial means to do so. So what he did is he set up a donor advised fund with appreciated securities. And then every year when his family was home for the holidays, his grandchildren made a PowerPoint presentation for him about which charities they thought the distribution should go to that year. So it was a great way to get the entire family involved in something that he was so passionate about. Yet at the end of the day, he was still the person that was funding it and receiving those tax benefits.
Bobby, it's one of the reasons why I literally opened it up and funded it right away. Is for my own 4 children. And we did the same exact thing. That's been a strategy that we've been employing in the Schein household at year end. And it's been so impactful, especially for the next generation, to get them in line with sort of the values that are important. And each one of them have their own different passions and values. You just want them to look look up from their shoes, see the world around them, and see how they can make a difference. So we've done that many year over year in the Schein household, and we've got that coming up as well. And that's wonderful.
Oh, that's fantastic.
Before we get far down the line here and wrap this up, because I really think, Bobby, what we're going to do is we're going to do a series of these, because right now we're going to sort of tease what we know. We know that between now and year end, a lot can happen in this legislation, and we are far from over. So we're going to have you back for sure. But one last question I'm going to ask, and it's kind of a fun topic, but it's legislation that has been about to change. It's about the cryptocurrency and the crypto world. And everything sort of a NFT. We're going to do a podcast. We're going to start a podcast series next year for our clients, and that's going to be our first episode. Is sort of unpacking what's crypto, what's NFTs, and what's all that fun stuff for all of our clients at Blanke Schein Wealth Management. In the meantime, here's the deal: if you've owned cryptocurrency, it potentially could have appreciated. If so, what is the IRS concerned about this year, and what's going to change?
Yeah. So as of right now, it's interesting. Cryptocurrency is obviously becoming more and more mainstream every single day. But our current wash sale rule, if I were to sell a share of Apple, today at a loss and then buy it back a few days later, the wash sale rule applies, right? Well, the way that it's currently written,
that means you won't be able to, real quick for the viewers at home, if you were to sell Apple and a few days later buy it back and you sold it at a loss, you have to wait 30 plus 1 day technically, to buy back that same stock in order for you to claim the loss on your taxes that calendar year. So we call it's a 30-day rule. We call it 30 plus 1 days to be safe here for our clients. But unlike stock that Bobby just referred to, in this case, Apple on the wash sale rule, cryptocurrency is literally different at this moment in time.
Yeah, that's correct. So the wash sale rule does not apply to cryptocurrencies, because the way the law is actually written is it specifically says, for publicly traded securities, whereas cryptocurrencies are more so considered, a non-fungible token, I guess. I'm not exactly the most hip when it comes to the cryptocurrency and the NFT world. So it definitely sounds like I need to get onto your podcast and follow along a little bit closer. But what the legislation would address is that the wash sale rule going forward would apply to cryptocurrencies as well. And when I guess this really came about is when we saw the big crash in Bitcoin, people were selling it at a loss, taking that capital loss and then realizing that they didn't need to wait 30 plus 1 days in order to
1 minute later buy it back.
Exactly.
Yeah.
So that is something to be aware of that could certainly come into effect next year. And I mentioned that even if the Build Back Better doesn't pass, they may strip out a couple of pieces they like. That is certainly something that I could see being stripped out and passed along a standalone basis, because obviously they realize there needs to be an immense amount of regulation when it comes to these various cryptocurrencies.
So here's the bigger picture of this. And I was kind of, internally laughing, because I'm thinking to myself, the IRS is basically looking in the rear view, right? They're trying to change legislation, but life is happening so quickly through the windshield, right? And that's the way everything is. And that's so what I like to say is I love getting the team together for our clients, whether, again, the estate planning attorney, the CPA, and us here at Blanke Schein Wealth Management, to literally look at what are the laws, what are well within the realm of possibilities to save some tax-wise and tax advantageous strategies, both in the short term and the long term, but keeping that plan both relevant and flexible, right? Anything we build with our financial plan for our clients, it has basically the flexibility, and we can change as tax law changes. But as we're looking, tax law is in the rear view oftentimes, and we live with our planning teams through the windshield. So we're always either a step ahead or making certain that, obviously we're not in the crypto world with our clients, but we're getting the education along the way. But I'm just using that as an example of the wash sit rule, that how the IRS or legislation is basically living in the rear view, and they're trying to play catch up. And it's always going to be the cat chasing the tail here, or the mouse in this case. But it's just kind of funny to see how this all plays out. So let me give you this sort of for our clients at home as we wrap up what we see, and we're going to put the prediction out there for 2022, and this could be dangerous. I've been often known to put my neck out there as it relates to our YouTube channel. We have our insights and observations. If you're not liking and subscribing, we encourage every one of you. Again, it's free, and it's information that we have for you. And now is the time, year end. We got friends and family. Please share that information. We have well over 62,000 hours of viewership time. So it's well more than just my mom watching. I know that we have we have some clients that are watching too, which is very exciting here at Blanke Schein Wealth Management. So my point here is we're constantly going to be on the forefront of these issues, and we're always going to be talking about strategies and tips and techniques and things that our clients can stay well ahead of what's to come. So we're going to have you back, Bobby. I appreciate it today. And I think that's it. We're going to wish you happy holidays, Merry Christmas. I think we have 10 days left to get everything in order in your household. I have yet to start.
Well, luckily, I have a wife that really took advantage of all the sales over Thanksgiving. And I will say, though, every time I take the dog out for a walk, there's at least 3 to 4 more packages sitting on our front steps waiting to be carried in. So I think I am done. I probably have a lot of wrapping to do over the next 10 days. But I really appreciate you having me on today, Rob. And I certainly look forward to getting together again in the new year. And hopefully we've had a lot of things happening between now and then.
Sure.
And, we're not talking about the same old things.
Oh, I didn't get to it. I just remembered the prediction.
Oh, yes.
Yeah, the prediction. So for next year, again, we think divided Congress, and we could see what we saw in 94. I actually said this in one of my earlier webinars for clients that were concerned about what's going to happen. Again, this isn't political. This is sort of what we're reading on a daily basis as to the lay of the land. And right now, what we're seeing is we can see a divided Congress. And much like 94, if you go back to 94, you had in 92, you had Bill Clinton come in and he had 3 branches, right? He had all 3 branches were in the blue side. And so they came out with really aggressive and progressive policies, a lot of spending, a lot of initiatives. 94, we had, again, the Federal Reserve came forefront of raising interest rates for the first time since 1989, and changeover from Volcker to Greenspan. So in this case, we still have Jerome Powell still maintaining his job for next year, but we have the Federal Reserve squarely in the headlines. Actually, today, right now, that's why I was paying attention to the market, because he kept rates unchanged, but he's talking about next year. So the Federal Reserve is going to be at the forefront. They're going to be aggressive, hawkish. They're going to have to raise interest rates because we have obviously inflation right now. Both you and I, we're all feeling it. That being said, back in 92, again, progressive legislation, and then 94 hit. And that's when you had the red wave. In fact, if you look in Wikipedia and look it up, they literally call it the red wave that happened with regards to Newt Gingrich coming in and the House changing over. And that basically put a stop to all the spending in Washington because you had divided Congress. And markets under that, historically speaking, under divided Congress, doesn't matter if it's a Democrat or Republican in the White House, Congress needs to stop spending. And that's sort of, I think, why the market has sort of a sigh of relief as we get to year end. Corporate earnings and personal income, right, are all up and unaffected. And so we have, going into 2022, we could see higher taxes, but maybe not. And we could also see a change of guard in Capitol Hill. And that could literally change, again, the whole sort of initiative and agenda on a go-forward basis for the final 2 years. But more importantly, for just the budget and taxing and spending, it could sort of give a sigh of relief, a window of opportunity for the back half of that. Now, keep in mind, we had in 80s foundationally Reaganomics, right? You had Larry Kudlow, you had Stephen Moore, you had obviously Ronald Reagan, who had to take care of inflation back then. And then once they did, they had a solid economic foundation. That's what's happening today. Clients ask me all the time, why is the market up because we have a Trump economy. Don't shoot me. This is the fact. We have a Trump economy because we haven't changed the tax law since 2017. Okay. Corporations are still under the lowest tax laws that we've seen. And that's why earnings are up, all-time record highs on earnings, right? It's a fact. We have a Trump economy under Biden restrictions. We got coronavirus restrictions. We have restrictions on sort of everywhere we see some oil and gas and energy and complex. You got a lot of stress, but it's nothing like foundationally and fundamentally. So the Federal Reserve has a credibility issue that they're hopefully addressing right now while we're on this. That's going to be squarely. We're going to look at corporate earnings on a go-forward basis. And we're also going to keep our eye on Congress and what they do. If we get this split and we get Congress shutting down, they can't spend too much money or tax. I think we could see what the setup was back in 92, all the way back to 95. We got through the Orange County crisis, and then we also had the recession, and they raised interest rates like 6 times, right? So we had that pullback, but in 95 to 99, if you think equity valuations are overvalued today, they might not be. And this is what I mean. The markets like to see, and they're seeing through right now, what the setup potentially could be. It could be back then. History may or may not repeat itself, but it certainly rhymes, as we say in the equity markets, in the financial services market, is that from 95 to 96, 97, 98, 99, for those years, the S&P 500 was on average a 27% return. That's because you had foundationally a strong setup, economically speaking, from Reaganomics. You had a divided Congress from 92 all the way through the 2000. Obviously, you had Greenspan, fuel and equity bubble that was unfortunately popped, and maybe rightfully so. But there was a lot of a lot of pain back then. But between now and then, there was about 5 or 6 years of unbelievable economic growth, and technology was the component. So now we just saw a pull forward because of coronavirus, a technological revolution and adoption. That was, they say, right? Experts say 5 years. Everyone, we're doing Zoom right now, and I could guarantee you that 5 or 10 of my clients really didn't have Zoom or the adoption of Zoom before the pandemic. And that technological pull forward is helping the efficiencies. It's also hurting the labor market, but it's also helping corporate balance sheets. So I think we've got a good setup on a go-forward basis. We got to see how the Federal Reserve, really plays their hand. And we can see how the back half of this time next year, what Congress in Washington look like. But Bobby, again, our best wishes and blessings to you and your family for this holiday season. Thank you for your time today, and we will be in touch. And for all of our clients at home, from our family to your Blanke Schein Wealth Management, we love you, and we thank you for always being there for us, and we're always here for you. And if you have last minute year-end stuff you want to get for us to take a look at, we're here for you. Or just to say hello, and your wishes, we're here for you as well. So you guys have a great day and take care.
Thank you.